Well, it has been a major crisis. It has been compared to the 1930s crisis, to the Great Contraction or the Great Depression in America and in all developed countries at the time. So it's been quite an extraordinary, severe crisis. What we have learned is that it is key to maintain the stability in the amount of money in circulation, both in the expansionary years of the cycle and in the recession or the recessive years in the cycle. We cannot allow bank deposits or money in general to grow too much in the good years, and we cannot allow either for money to fall too much in a banking crisis. So this is one of the major lessons we have learned. In times of a major crisis, a banking or a financial crisis, it is for central banks to act promptly and effectively as what we call the lenders of last resort of the economy, which means providing liquidity to banks in crisis. By liquidity, I mean lending, extraordinary lending. It's not a gift. The loans need to be repaid, but at least what the central bank is doing by injecting this money into the economy is to maintain the amount of money in circulation quite stable. That's one of the major lessons we have learned. The other lesson we have learned is that indeed central banks are key institutions in understanding the economy in our days. The major two roles we have granted central banks to achieve are price stability, but also financial stability, and this is something, the latter, we had forgotten before the crisis. And finally, and this is much more technical, we have learned that the increase in the balance sheet of central banks, what we call the monetary base, is not so much correlated with the increase in the amount of money in circulation. So the money we all use in the market, in our transactions. Why? Because many other things happen in the economy, like, for example, bank regulation. So in the midst of the crisis, for example, most developed countries agreed on tightening bank regulation, in particular to increase bank capital ratios and liquidity ratios. So at the time when we were asking banks to provide more liquidity to the economy, we were asking them to raise their capital ratios, which was counterproductive. This is another lesson from the crisis, which is not to change the rules of the game, not to tighten bank regulation in a time of a severe banking crisis. Well, what we have learned looking forward is that central banks should not be so much concerned about a very narrow definition of inflation, which in the last few years has been, or before the crisis, had been the consumer price index inflation. Indeed, it is important, but it's not the overall comprehensive measure of inflation. In my view, we should concentrate much more on the analysis of money growth in the economy, a broad monetary indicator, such as M4 in this economy in the UK, M3 in the Eurozone, M2 in the US, etc. What I mean is that much more than concentrating our analysis on a very narrow definition of inflation, such as the CPI, why not analyzing changes in broad money as an indicator of inflationary pressures in the future? Inflation in consumer price, in the consumer price index, so consumption, goods and services, but also asset prices. This is a much more comprehensive approach to monetary policy. Many other things we have learned, to be honest, such as, for example, we have to intervene in markets whenever there is a financial crisis much more promptly. Another thing we should learn is not to overexpand the amount of money in the good years, as it happened from 2004 to 2007. In most developed economies, money grew too much in those years, leading, or at least contributing to an excesses actually in financial markets, in asset price inflation, for example. That's not sustainable, as we have learned. So again, we should develop a monetary strategy by which the amount of money in circulation, broad money, is rather stable along the cycle.